and 5 years of sustainability work and experience across sustainable finance, ESG reporting, investing, and philanthropic project management. Just a reminder again, if you have any questions for Rebecca, Monica, or Tina, please drop them into the Q&A panel. I'm sure most of you that have joined our webinar know a little bit about South Pole, but just a quick overview for you. We are a profit for purpose company, founded in 2006 in Switzerland. We have a mission to enable corporates, capital markets, and the public sector to reduce their impacts on climate change and mitigate risk whilst creating value on their own sustainability journeys. We started 15 years ago primarily as a carbon project developer, in fact, in the Asian region, where we're still very strong. And we now have the largest portfolio of climate action projects around the world. Over the last 15 years, we've extended to a full suite of offerings, and we have grown to almost 800 experts across 28 offices and representations around the world. So, on to today's topics. Why investors need to take action. Just want to highlight a few of the impacts that drive the space and why financial institutions need to take action now. As all of you are aware, regulation in particular through net zero commitments made by countries across APAC are coming into play. Towards the end of this year, we have a meeting of the COP in Glasgow, and Article 6 of the Paris Agreement brings further urgency to what financial institutions have to commit to, and of course customers as well, who are demanding low carbon solutions from financial institutions. So, without further ado, I'll pass straight to Monica to jump into her first piece to discuss leading engagement with financial institutions. Over to you, Monica.
Thank you very much, John. Well, thank you for having me, first of all, today. This afternoon, I will give an overview of how CDP works and how CDP supports the journey to financial institutions to measure and manage the environmental impact. And later on, I'll briefly touch upon some findings from our financial services disclosure on portfolio emissions. So right now, for those who are not familiar with CDP, I will give you a very brief overview of who we do, what we do, and why we do it. So first, CDP is a non-profit organization, and we really aim is to pioneer environmental best practice through our disclosure platform from companies, cities, states, and regions. And as of last year, we have over 10,000 organizations disclosing through our platform. As you can see here in this diagram, we have over 600 financial institutions really asking companies for their environmental disclosure. And how that is asked is through a standardized questionnaires on climate change, water security, and commodities relating to deforestation. This questionnaire is very much aligned to TCFD, the Task Force on Climate-Related Financial Disclosure. And that data we gather, it's fed back to our investors for them to use, and it goes beyond to the broader ESG ecosystem, to policymakers, to academia, other investors, and other service providers as well. And I really like to give a reason why we do this is because CDP believes transparency is the is the foundation to take action as well. Next slide, please, John. So here, I'd like to just touch upon how we work with financial institutions. Now, we've seen a real growing momentum for financial institutions announcing net zero targets. And this slide kind of shows how the various work streams within CDP come together to support the work that needs to be done for financial institutions on their decarbonization journey. So here, one of our core strengths in the data and the engagement. With that, the financial institutions need to set a target and it has to be in line with the most relevant science. As you know, well, CDP is a founding member of the Science Based Targets Initiative, where we work with financial institutions to set targets. And obviously, to be able to do that, you need the tools and data to do it, to find where your portfolio alignment is in the transition planning. And how that gets fed back into CDP is through our disclosure platform by reporting and tracking over time. Next slide, please. On this slide, I want to just emphasize that net zero, when it comes to financial institutions, it's really about creating the positive loop between investors and companies. I like to call it like transformation loop, as you call it. As you know, financial institutions are really uniquely positioned to influence companies through their investment and lending activities. So they have really the ability to drive emissions reductions in the real economy. And from a CDP standpoint, we support that engagement through various collective engagement initiatives and campaigns that we have, but also through bespoke one-on-one working with various financial institutions on their needs and focus areas as well. Next slide, please. So here is last year, I like to mention, like, for the first time, CDP has been, the reporting has been going for past 20 years, but for the first time, CDP has added on the financial services sector. So we've asked about 750 listed financial institutions to respond to our question last year, of which about 330 financial institutions did. The reason why we added this is to really have a baseline assessment of like how financial sector's readiness to a low carbon economy, how ready they are. As John has mentioned, there's a lot more reporting required to financial institutions, especially in line with TCFD reporting from regulations that are coming out. And also really to capture, the financed emissions, how aligned are the investments and loan portfolios to the goals of the Paris Agreement. So here we find that there was a good mix of financial institutions, some banking, investing, and insurance as well. You see overlap because, some financial institutions undertake more than one activity, as you can see on the lower left-hand corner, and you can see the global distributions on the right. Within APAC region, there were 85 financial institutions disclosing. Majority, I would say, were from Japan and Australia, but also there's a good mix of various other regions as well. Next slide, please. So now the findings, the conclusions, and it was actually the first time that that most financial institutions, the climate impact is really driven by their financing. And it's the first time that we have actually put a number to find like data points that support this as well. So out of the 330 financial institutions that disclose to CDP, only 25%, this is globally, only 25% of those said that they have reported on the financed emissions. And surprisingly enough, I was very surprised by this, was that almost 50% had indicated they do not conduct any analysis on the portfolio impacts, which, over time, they will need to build up capability and probably awareness as well. But this is where we are standing as of last year. And also, another finding of those that have disclosed, the 25% that have disclosed the financed emissions, we have found that comparing to their operation emissions, this is the scope 1, 2, and non-finance scope 3 emissions, versus their scope 3 finance investment emissions, their finance emissions came to an average 700 times larger than their whole operating emissions. Even within APAC, the range is very, very different because depending on where the financial institutions, their journey is in, You have some saying like we have over 2,000 times the operation emissions to some who are very early on in the journey. So the range is very, very high, but on average, we have on the global 700, which is still significant. And as more financial institutions, look into their own emissions, you will see like probably the number will increase over time as well. With that, I would say I will stop here for now, and I will pass it on now over to Rebecca, who will, go into further details as well. Thank you.
Thank you, and thank you, Monica. Thank you, John. And I'm very happy to be here today. Thank you for joining. I suppose I maybe have the short straw. It's quite an early morning where I am, but I hope you've been having a good day. So we've heard a lot about why financial institutions, investment portfolios can think about disclosing and measuring emissions. I have a few slides to talk about what they are, and it's pretty high level. So let's get started. On the next one, we have an overview of the greenhouse gas protocol. And this is many decades old now. It predates the Kyoto COP, so COP3 back in 1990s. And it sets out a number of scopes of emissions, 3 scopes of emissions. Now, scope 1 is direct. Scope 2, indirect, while manufacturing, and then scope 3, the value chain. So for a normal company, and let's say my favorite example, a car manufacturer, the direct emissions will be while manufacturing, so scope 1. Scope 2 will be the energy used while making the car, which is scope 2, so indirect. And then scope 3 is the moment the car is taken away from a garage forecourt and then driven. This means for the financial industry, as Monica said, the majority of the emissions are in those downstream activities, the scope 3. And for the financial industry, the scope 3 emissions are made up of the companies in the portfolio, and a pro rata is completed to take the share for the particular financial institution, looking at the debt or equity holdings or lending that they have the exposure. So the scope 3 for an investment portfolio is made up of the scope 1 and 2, the portfolio companies, and a pro rata completed. Just one other point to note here, in the EU, by 2025, there will also be a requirement via the EU taxonomy that investment portfolios, financial institutions include their scope 3 of their portfolio companies in that downward value chain emissions. So this will be extending over time. Now going on to TCFD and one of the uses of those emissions. And TCFD came about in 2017. It's a set of disclosures. It applies to all different industries. And there's an example on the next page. It's now being implemented by a number of multinationals, and a number of regulations are also starting to include aspects of TCFD. When I think about TCFD, I really think about a bit of a Venn diagram. So firstly, there's the requirements themselves and the carbon emissions, which underpin a lot of the analysis. There's then setting targets and SBTI, so the Science-Based Targets Initiative, as a result of those carbon emissions and the impact that climate change may have on an organisation. And there's also other areas such as governance and strategy. So there's the quantitative information, there's the qualitative information, and then there's target settings and initiatives. And as much as possible, it's about trying to bring those things together so there's a really solid base for TCFD reporting. On the next slide, go into a little bit more detail on TCFD and the different areas. And just to dive into really what this is and risk management. So the question that TCFD is asking is, what is the impact of climate on you as an organisation? So it's not the other way around. So these impacts, transition risks, physical risks. So transition risks could be related to swift policy change or even limited policy change on climate action. Physical risks could be more severe weather and climate. These things will happen. Many are baked in already. We don't have a choice as a planet anymore. So the question TCFD asks is, what will those impacts which are happening externally have on me as an organisation? And it asks a number of what if questions. So it runs some scenarios and what will happen? What if these things play out? So from a risk management piece, it's looking at these climate risks, and then the metrics and targets is underpinned by the carbon emissions, but also those scenarios. TCFD is quickly moving to mandatory. It will very likely be included in IFRS and accounting soon. At the G7, the finance ministers indicated that it will be mandatory in those countries. And it's also supported by the stock exchanges, for example, in Indonesia and Malaysia for the companies that list there. It's underpins and part of the thinking in the Singapore stress test for the banking system, and in Japan, this is moving to mandatory quite quickly too. So lots of compelling reasons to look at it. And then the final slide is looking at a type of implementation plan and some examples of where South Pole can help. And really, the work on TCFD starts with understanding the practices today. Some of this will already be going on in organisations, for example, on governance. Look at the TCFD recommendations and perform a gap analysis. So that's usually a starting point. There's then also workshops and education and raising awareness inside an organisation as part of this journey. Then having some form of plan, an evolving plan. It expands, it evolves over time, and then the reporting. So these are just some of the steps with TCFD reporting. But enough about carbon emissions and what TCFD is. I'll now hand over to someone who's done it in practice. So over to you, Tina from HSBC. Thank you.
Thanks. Thanks all. Thanks for having me here. I don't think I need to spend time to introduce HSBC. We are one of the biggest international banks in the market, and I'm very happy to share my view today because it's just around 1 month ahead of COP26. I think I don't need to mention the importance of COP26 because you already joined this webinar. It means that you do have some basic knowledge about what is climate change is. So I will share a little bit more about the Asian reality. You can see that till now, Asian is the largest emitter. We are counting more than a little bit half of the global emission for carbon. However, we are the home for more than 16% of world's population. It means that per capitalized emission in Asia is slightly lower than the world's average. However, you can see that the chart here is that in 2020, TCFD, they have a status report and they revealed that more than 300 banks in Asia, and they just find out that only 31% of them disclose their climate-related matrix. I'm not talking about they all adopt TCFD. I'm just talking about the disclosure, some carbon-related matrix. While our peers in Europe, you can see the number is much higher. It's like 15.8%. So it means that there's more room for Asian financial institutions to disclose more about carbon-related data, no matter whether they adopt TCFD or not. In this year, we see lots of movement in the government, in the Asian countries. So first of all, I want to quote the CDP's data because 2 weeks ago, CDP also published a policy summary. They outline all the mandatory requirements or TCFD alignment around the world and especially for Asia. I highlight some development in Asia country. You can see that in Hong Kong, we recently announced that the Hong Kong government decided to develop a two-tier system which requires the enhancement disclosure for larger fund managers, because you know that Hong Kong is a financial hub for different lots of different funds, and they are required to disclosure more carbon related as a mandatory requirement. And also in India, the Security and Exchange Board recently also issued a circular notifying that there is new disclosure requirement on sustainability related disclosure, including carbon or environment related disclosure for the top 1,000 listed company by the end of 2023. So we have 2 years to go for Indian listed company. And for mainland, we do have we already have the volunteer green investment guideline back to 2018. That's a few years ago. And you see that every week or every month, the China regulator like PBOC, they are still trying to implement mandatory disclosure for carbon or related information or carbon stress test, climate stress test in before the COP26. So it means that every country now, let alone the Singapore, they are actually leading the Asia. They already in last June, they already have encouraged fund to manage climate risk based on the TCFD framework. And this year, they also announced several regulations to emphasize the importance of it and make it a mandate requirement for more, especially for listed company. It means that more and more countries, the government already put pressure on different entity, no matter it's financial institution or investment fund or company. And you can refer to the CDP summary because I only cover a small part of it. And the other country, if you're interested, you can go to CDP's website to download the report. I think it's very helpful. So that's the Asian nature. So last page is about how HSBC are doing it for this agenda. So John, please move to last page. So you can see that back to 2017, we have already pledged 100 billion in substantial finance by 2025. And in last October, we made a further move. You can see here that's 3 pillars is our overall strategy. The one in the left side is how ourselves as operation to achieve the net zero ban, and also our including our scope 3 disclosure, supply chain disclosure, scope 2 and scope 3 disclosure to become net zero. This is the first pillar. The second pillar in the middle is how we support the customers, because there's lots of opportunity for sustainable finance. For example, in 1 hour later, we will launch the China Green Bond Market Report with Climate Bond Initiative. You know, it means money for financial institution if we do well to help our customer to transition into net zero, or especially for the high carbon industry. So it means money for banker or for other consultant as well. And so the last pillar of it is unlock climate solution, is that there's lots of initiatives. For example, we support the lots of clean tech investment or philanthropy program, especially in Australia. Yeah, the blue carbon thing. So we also do lots of projects in that. You can see that through all these pillars, helping ourselves, helping our customer, and then the fintech and charity, we will create. This is the overall the carbon strategy for HSBC. So back to the disclosure itself, you can see that we have already joined CDP quite a long time ago. And Monica just said that we have 85 banks around to submit the CDP score, and we are one of it. Last year, our rating is A-. We are in the leadership band according to the peer comparison. Averagely, the Euro company, the average rating is C, and the financial sector average rating is B. And HSBC, luckily, we are achieved A-. Our challenge is like what Monica and Rebecca shared, that is the scope 3 disclosure. For example, is 700 times higher than our own operations emissions. So you can consider that we have present in more than 18 countries. So for data, there's lots of data involved to make our disclosure more accurate. So as a result, we are the first first batch of banks to join the TCFD disclosure, and we already disclosed the quantitative report in no matter government strategy and risk management, all the circle, all the TCFD circle back to 2017. 2017 is the first year annual report that we report our TCFD, and also in 2020, we last year we initiated a pilot to build up our knowledge of PECA. It's another mechanism to enhance our understanding and effectiveness about how we explore the complementary mechanism to connect sufficient data. The PECA one now covers 6 climate-related industry. For those oil, gas, coal, power, automotive, steel, because this 6 industry is the key to transition to a low carbon economic. So we are focused on these 6 industry recommended by the PECA mechanism now. It's still evolving itself, so it takes time, maybe a few years to have a full picture of how it work out in disclosure, but we're working on it from last year. And this year, we will also continue to see whether we can apply this more than this 6 industry, maybe more industry like sustainable consumption or consumption industry, retail, that kind of partnership with different consultants. And in this year, we HSBC joined a partnership with Carbon Accounting Finance. Is another big wording begin with P, is PCAF. So it helped the bank to measure and disclose its financial emission and how it achieved to net zero by different steps. For example, it's a little bit comprehensive mechanism, but we already discussed it in our. We will disclose it in our this year's financial report. So maybe some months later, you can see how we get the first draft of data and public to see the using this new accounting mechanism for carbon. And it's a collaboration between different financial institutions. We are learning from each other, from the peer. I hope that we can enable us to get a better understanding about our asset or our portfolio's carbon intensive. So we'll share more when it finally lands. All in all, it means it also means a loss of opportunity for HSBC. Like I already said in the middle of the pillar, is that sustainable finance is mainstreaming, and so our financial institution like HSBC, we should not only focus on the risk or the mandatory requirement by the governments. We also need to be a forward-looking opportunity or business strategy about how to support our customer in low carbon transition. So company like us should think how to fully integrate this climate factor at our product and at the boss compensation and executive or our ESG rating. All this is it's not only what I mean is that it's not only a risk or it's a task for us to take boss. It also means business opportunity. So that's how we do lots of training with our frontline RM. You know, we have more than 200,000 frontline people across the world. So we do lots of training to let them know the importance of it and try to help our customer to transition to no carbon. And I think that because we are close to the COP, I think that Asia is still a little bit left behind compared with our Europe peer. So it will be in the coming 2 or 3 years is very important and significant milestone for Asia market. We can discuss lots of it. We can discuss more in the Q&A session if you have any question. And yeah, the final pages are my linking QR code. So if anyone want to exchange more with me, please scan it and we can discuss more privately if we don't have sufficient time covered in the Q&A session. So I will hand over back to John for it. Thanks.
Thanks, Tina. Hopefully everyone's got a chance to quickly scan that now that we have the QR code at the top of our home screens on the phones. That was really insightful. Thank you very much to Monica, Rebecca, and Tina. We'll quickly summarize what I would perceive as the key takeaways here. I think, Rebecca, you framed TCFD also very well in terms of you've got to look at the impact that climate will have on your business as a financial institution. I think that's critical. For Monica, obviously balanced reporting is key, and I really loved, Monica, how it's a positive feedback loop that we're effectively creating here with this reporting as well. And of course, we'll never have perfect data, and we've got to start now. And I think you've obviously shown us that in Asia, disclosure rates are lower, Tina, and that you don't have to wait for things to be perfect before you can start this journey of reporting and understanding your emissions profile, and of course the potential climate impacts that will have on your business too. So we'll move straight to the Q&A session. We do have some questions coming in, so if you're still listening into the webinar, please do drop a question into the box, and we'll start straight away. It looks like this one's definitely aiming towards you, Monica. Currently, the SBTI and CDP do not include emissions from insurance underwriting in the required Scope 3 target setting or reporting boundary. Will this change in the near future?
Yes. So basically, SBTI at the moment for financial institutions, the guidelines came out end of last year. Now, it is in its pilot stage, meaning the assets that are covered, there's only like limited assets at the moment that are covered, and then that will expand in the years to come. So there's a set of guidelines that are revision coming out in the months down the line, and then the following year as well. So yes, under that will be included part of it in the next round of improvements. Yeah.
Very good. Thanks, Monica. Yeah, I think so. Rebecca, this one looks clearly tilted towards you as well. As a new and growing company, we'd like to get an idea of our business's emissions profile, specifically tracking, calculating Scope 1 and Scope 2 emissions, and what the business looks like from an ESG perspective before we can create an action plan to reach net zero. What services can South Pole offer in this context, and how much will they cost?
Yeah, thank you for the question. And I'll answer quite generically. So South Pole offers services to measure operational emissions. That's via our environmental impact accounting team. So that's certainly something we can help with. Usually for financial institutions, that would be buildings, energy, perhaps some employee commuting, business travel in there too. And on the Scope 3 side, for investment portfolios, we can also help with measuring, and we use the PCAF standard, which Tina mentioned earlier, and then we can also help set science-based targets. And that's via the sustainable finance team. So in short, we can offer those services and support. And perhaps for those who are getting started or earlier on in the journey, I mentioned during my presentation workshops, and this is something that we've seen has been beneficial for some clients, is to have that in-depth training, awareness, look at some top-down analysis, some screening for their particular organisation. So for example, we can start to work through some of that and ask questions and look at the gap analysis in a workshop. So I would just highlight a piece as well. And on southpole.com, there's lots of information if you put that in Google, and that includes contact forms. And if you put an inquiry, then we'll be able to provide some indicative pricing, so you can get a sense of the costs as well. Thank you.
Thanks, Rebecca. Perfect. I was wondering what you're going to get to in terms of cost there. Tina, looks like one here for you as well. As you mentioned, there's not as much disclosure in Asia as there is in Europe. I mean, we have a question that says, if our portfolio emissions are high, should we still disclose them, or are we actually better to try and reduce those first? How would you view that from an Asia perspective?
I think that high is also comparatively. If you don't disclose it, you don't know whether it's high or not, right? So everyone need to disclose, so we know that whether exactly. Maybe after you disclose or everyone disclose, you will find that actually you are not that bad. you may be leading. So it's only everyone disclose it. It can be more compatible figure. And also, I missed to mention one point is that the stakeholder also requests a financial institution to disclose it. It's government, business opportunity, and also stakeholder. You see that lots of stakeholder, for example, most of the banks are actually held by asset management company, right? They are institution investor. Most of them largely is not by individual, most is by institution, and they are now in lots of the storage and engagement strategy of them require them to push their investment portfolio like us, the invested company, to disclose it. So we actually don't have a choice, even it look back in the data. And trust me that the more you disclose and make it transparent, the senior leader, they will awareness the value of it. It will be a top-down approach to see how we can reduce it. So even it's high, I think we should still disclose it. Yeah, you can see the improvement, right, at least.
Yeah. I can add on a little bit on that. From the numbers or the disclosures that we've seen last year, having a high scope 3 emissions, especially on investments, is kind of an indication that you're doing a relatively good scoping and a good job of it, because we're finding the more advanced, the more aware the financial institutions are, the higher their investment emissions actually come to. So it's quite, and also an important fact is you can't manage what you can't measure. So measuring is really the first step to managing and seeing what impacts or what areas that need to be done. So that's like, it's not a bad thing at all. Yeah, I just wanted to mention that. Yeah.
Agreed. Thanks, Monica. We highlighted, I guess, the importance of COP26 towards the end of the year. And there are a lot of acronyms we've mentioned on this call, and there's a lot of terms, I guess, across this business. But what does net zero, this question is, what does net zero actually mean for financial institutions? I don't know who wants to put their hand up for that one.
Perhaps I'm happy to start, and very open to other comments. So net zero, put very simply, and there's the bathtub analogy, it means keeping carbon emissions level, so not releasing more and keeping them static and at zero, put very simply. And using the bathtub analogy, in a bathtub there are two ways of doing that. One is by turning the tap down, so avoiding emissions. The other is by pulling a plug out, so removing emissions. So put simply, keeping a level amount of emissions, and two ways to do that, by either avoiding and reducing those carbon emissions, such as the tap, or removing the emissions by putting the plug. And in the first instance, there are a number of different frameworks for net zero, such as the various COP alliances, and I'm sure we'll hear more about that in November from Glasgow, where the COP's being held, but also the SBTI, the Science Based Targets Initiative, that provides a target setting framework. And in the first instance, the big focus for investment portfolios is usually on the decarbonisation piece, on turning the tap down. Just finally to add, usually net zero, and I would say in the vast majority of cases, is a forward-looking goal. So it's something in the future. It's quite challenging to be net zero now, because it does imply reducing those emissions and then removing them. And there's still some way to go globally for us to reduce emissions. So usually it's a target set in the future. It's a commitment made at a group level, or at a parent level, or at a company level. But then there's lots of detail to work through what that means for the different business units, different business lines, and how those targets get cascaded in an organization. So at the moment, we're seeing lots of alliances, commitments, and agreements in writing. And I think over the coming years, we'll start to see a lot more of the plans around how net zero will actually be achieved, and the actions being taken in the short and medium term.
Yeah, As Rebecca mentioned, net zero is, I would say, to be very honest, is not a fully defined term yet for financial institutions. It's a working process. At the moment, Science Based Targets Initiative, the group are working on what that actually means as a financial institutions. We hope to see something outcome 2023. It is a little bit further down the line, but what that would mean for financial institutions in the short to medium long term to get to net zero as well, and the definitions and the asset classes and the variations around it. There's one interesting thing that Rebecca has pointed on is the forward-looking element. So decarbonization, when it comes to financial institutions, looking into the stockpile of carbon emissions portfolio, carbon footprinting is important, but also when it comes to net zero, knowing the targets of the investee financing companies are very important factor as well that comes into play on how to reach net zero. So I would say those two are quite important, and that's where the forward-looking comes in.
Yeah,
that's very useful.
To add on, I think that I think Rebecca and Monica already share most of my understanding. It's not standard answer for this. Different government regulation, even for example, even for the sustainable finance, the green bond, they have different variations between country and country, let alone the net zero, which is totally a new world. And for financial institution, when you say net zero, it can be different thing for Chinese bank compared to a Euro bank. They might use different mechanism to do that. So there's negotiable standard, or there's no standard actually. There's a negotiable definition variance that in this industry. However, we believe that we all understand we are all agree on what is high carbon industry and what's the traditional financing, how to calculate it. I think this one can be at least easier for us to align. But it's still evolving. For example, the sixth industry, the high level industry like oil, that kind of thing, I think that's globally agreed. That's high carbon industry. And loans, project financing, this kind of financial instrument are also kind of standard, because EPMA already have lots of standard on financial instrument. Combining these two parts, I think that for this, maybe we can reach agreement in 2 or 3 years globally. However, how to make it net zero? How many paths? For example, as Rebecca just shared, we can support more renewable energy company, right? Solar or carbon capture company, and we can also invest in some. We can do carbon capture ourselves as a bank. We can also do that. So what's the approach to reduce it, and how to help the customer, especially in that high carbon industry like oil, how to help them to transit into net zero is more important. I mean, for a bank, it's first disclosure, alignment, and then how to help them to reduce their carbon footprint. Because we are not only helping ourselves to do that, our own net zero is one target, but the other more important one is that help the client to do it. So both of these definitions are evolving. I think that in the coming 2 or 3 years, as I shared before, is the milestone year for the whole industry for it, because I think we should have alignment, especially after the COP26. Yeah, that's my expectation for it. Thanks.
Yeah, no, fantastic, Tina. And I think that's a great way to round up this webinar as well on that question, and also highlight the urgency of the topic that we're facing here as well. So we'll finish up there. Thank you very much, Tina and Monica and my colleague Rebecca, for getting up early in London. It was a super informative session. And again, thank you for everyone that's attended and listened. Feel free to continue to ask questions or email us or contact us, and we can get back to you with any other follow-ups as well. So thanks again to the panelists. Fantastic conversation, and thank you for listening in.
Thank you.